presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak Asset Management YouTube update for April the 11th, 2023. I'm Mo Ansari, President of Compak Asset Management, and thank you for joining me today. I'm going to talk a little bit about the economy, what's going on with the economy, where we are now, take a look at the weekly technicals, and a look at the week ahead. I think the biggest report we are going to see talking about the economy, looking back a little bit, Friday we had the unemployment data come out, and it's still jobless claims are higher than last year, but still very, very low. That's the jobless claims. Then we had the labor market report come out at 236,000 jobs created. Expectation was 238. So we are right there. And so it was not a weak report, not a strong report. It was an okay report, but it did not persuade anybody or dissuade the Fed from raising interest rates. That's the guess right now. The market expectations were 50-50 that the Fed would increase interest rates by 0.25% at their May 3rd FOMC meeting. But after this report came out on unemployment, the expectation is 70% that the Fed is going to raise by 25 basis points. But if the Fed raises 25 and pauses, finally says, okay, we're done, the market, unfortunately, is still expecting that the Fed is going to lower interest rates second half of this year. I don't know who's thinking about this or how we're getting to this, because anybody that I talk to does not see any interest rate increases until 2024. But there is this market expectation that the Fed is going to lower interest rates. I think the economy is still doing okay. We are going to get a slowdown somewhere, and it appears to be softening a little bit. This is when economic activity is increasing, when it's coming down, it's decreasing, but we're still way above zero. So we are slowing down a little, but this recession that everybody has been looking for the last year and a half, it is the most advertised recession that we've ever seen. It's the most publicized recession that everybody has been waiting for on pins and needles. Has not happened yet. I believe we're going to get a slowdown. No one knows how big that slowdown is going to be. Is it going to be a deep recession, shallow recession? I think it's a slowdown, which is a shallow recession, is where we're headed. If you look at the ISM, the manufacturing is slowing down. You can see that right here, that the manufacturing data is showing, the ISM number is showing manufacturing. But manufacturing is only 20% of the U.S. economy. 80% is the services sector, which continues to grow. Everybody's traveling, everybody's going on vacation, everybody's going to restaurants still. So services have not slowed down. Services will slow down if unemployment starts to go up. But we have not seen that yet. If unemployment goes up, then people start to worry that, look, I might not have a job. Let me not spend this money. Let me not put it on a credit card yet. Let's hold off a little. And when people start holding off on spending, that's when the economy slows. But we're not there. Everybody has been talking about it. But I would wait until we see this slowdown and expect it. Again, everybody has been talking about how the dollar is going to be replaced by the Chinese yuan or the Russian ruble or whatever currency. The euro was the big thing 10, 20 years ago. Oh my God, the euro is going to take over the world and so on. If you ask anybody today, what would you rather have? Would you rather have dollars, Chinese yuan, Mexican pesos, or what currency would you like? Still, the overwhelming answer is US dollars. Somewhere, maybe it will change, but not yet, and we have to keep. Don't forget, we've got a new media page. You can go to and get all of these. Simply go to compak.com/media. You can subscribe to this weekly update, where whenever I put a update out, you will be notified. You can listen to my daily podcast, which is really taking the radio broadcast and we turn it into a podcast. It's a daily 1-hour broadcast, great shows. And you can download the Market app, the mobile app, where you can get the broadcast, a daily broadcast every day. You can register for upcoming events, subscribe to the iTunes podcast, listen to on the radio, and all the information is there. All you have to do is go to compak.com/media. Let's take a look at the technicals. Interest rates. This is the 10-year note yield. It went here. This was 4.3, and this was in October of last year. That's when the market hit a low, middle of October. When this interest rates came down, the stock market went up. We've gone back and forth a little bit over the last, and now we have dropped below the 200-day. This is the 200-day moving average. And you can see the yield has come down, but we left a 2-day island bottom here. We gapped down, gapped up, and when that happens, that's usually a turning point. So I think rates are going to stay in this range for the time being, which is about 4% right here and about 3.3% there, and just go back and forth in this range. No big deal. The big deal here is the S&P. It's still at the highs right here, right around the 4125 area is where we are as of today. This is the big number that I'm looking at, 4195. If we can break out above 4195, or this right here, this is the range that we have been in for the last 3-4 months. 3,800 on the bottom, 3,800 on the bottom, and 4,200. That's what I would say on the top. If we can break out, and there's this tiny gap here between 4,200 and 4,218. If we get above 4,218, this market is gone to the upside. Then we're looking at this high, which is 4325. And if we can break out above 4325, then the market is moving. But this 4200, this challenge, if we can break out somehow to above that, that would be a very positive indication. Hasn't happened yet. We got there in February, fell right back down from this number, came all the way back down to 3,800 with the banking crisis. Now we come back up. We're getting a little bit of a pullback right here. Support is right here, about 4060 or so. And if we can get above 4,200, we're on our way. Same thing, this major resistance area is 4,200 is what I'm looking at. Support now right here at the 50-week moving average, which is 3,960, and then the low that we made last October. NASDAQ, same picture, trading right here around 12.2, and we've hit that, got up here, got very close here, came back down. Now we're coming back up. We need to get above this number right here. And here's that gap again from August, which is 12.6 to 12.7. If we can get above that, I think that's going to be bullish, and we can get to 12.6 to 12.7 in this area. That also happens to be the Fibonacci projection from this high. So, as I've said, the NASDAQ needs to get a little bit of strength. Tomorrow we get the CPI. That could really move the market one way or the other. Inflation is expected to be around 5.25%. Big drop from 6%. When the core comes out, PPI comes out on Thursday, expected to be right around 5.4, which will be up for 5.3. So it's a mixed picture. But if we get that number, core still staying where it is, I think that'll cement the possibility of the Fed raising rates by 25 basis points. Create a little bit of pressure, but what the Fed says about that, and says if they're hitting the pause button, that could be good. I believe that we are going to go back and forth. I don't think we have enough energy in this market to get above 4,200 for the S&P, get above 12.2 for the NASDAQ. Those are two numbers that are critical. We'll have to wait and see if we can get above that. If not, we get into the summer doldrums, go back and forth, 3,800 on the bottom, 4,200 on the top S&P, until we get to the fall, and then we get some clarity on how deep the recession is going to be, how much the slowdown is. Everybody has already discounted earnings are going to evaporate going into the fall. So the bar is very low. If we get earnings that are even slightly better than expected, market will have to readjust to the upside. This is my dot plot, as when the dots are below the market. This is the market right here. These are the dots right here. The market is above it. It's in a bull trend. If the dots are above and the market is below, it's in a bear trend. You can see that when this is April of 2020, it started there till the beginning of this year, the market was in a bull trend. It turned down right here. It turned up for a few weeks right here, but turned back down again. But about 8 weeks ago, we turned up, and we've been up on that. And this number is about 11,000 now. We're trading at about 12,000. So if we can get above 12, the weekly trend is up. Gold has had a good run, Went up, made a third wave high. We're getting a fourth wave pullback. Support is going to be 1978 and then 1910. Anywhere in this area, if you want gold, you don't have gold, 1950 to 1910 is the area to buy. We'll see how the inflation number comes out over the next couple of days, and then we start getting earnings on Friday from the banks, and that's going to be the major driver of the markets this week. Those are my thoughts. Again, we have a live seminar. That's about a month and a half away or so. If you'd like to come and attend, you can make your reservations simply by going to compak.com. A week ahead, I think this week is going to be the major determinant of what the Fed is going to do, and that is what is going to drive the market. Those are my views. Those are my thoughts as of April 11th. Thank you again for joining me today.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.